Hello, welcome clients and friends of Mercer Advisors. My name is Jessica Caruso. I'm a senior wealth advisor and one of the directors of Mercer's Northern California team. Joining me today is Don Calcagni, our Chief Investment Officer. We are really looking forward to spending the next hour with you and having some interesting discussions, getting into some topics about what's going on in the capital markets. At Mercer Advisors for over 35 years, we have always kept in mind having this client-centric, client-focused approach. And in light of that, we're going to use that focus as a way to structure our conversation today. So prior to today's meeting, as part of the registration, we went out to you, our clients, and asked for you to please provide questions and feedback of things that you wanted to make sure were addressed on today's update call. So what you're going to see in front of you here is a word cloud of those responses. We took everything our clients said they want to talk about and put that together into some key themes, which you'll see in front of you here. So as I'm moderating through our conversation, we're going to focus in on some of these themes looking forward into the following year. You'll also notice on your Zoom window that there is an area to insert any additional questions live as we go through the presentation. So please feel free to use that as well. I'll have my Zoom screen up and we can monitor any questions as they come in as well. I'm happy to add some of those in to the conversation today as they relate to some of the other things we're talking about. With that, let's go ahead and dive in. So Don, welcome today. Before we start looking forward to this new year and talking about what's going to go on in 2023, I'd love if you could just take us back to last year, give us maybe a brief summary of what happened in 2022, any key themes or insights about how those themes affected capital markets.
Great. Well, thank you, Jess. It's great to be here, and thank you to all of our listeners for joining us today. So Jess, to your question, I mean, when we look back at last year and we ask ourselves, well, gee, what were the big themes? I think we can just look at our word cloud here. I mean, our clients obviously are paying very close attention to what's happening in the world. You know, interest rates, recession is now a significant theme that's starting to dominate the headlines. Inflation. I don't see inflation on here really big, but I know that that's really what's driving
Right.
A lot of what's happening. But interest rates and things like that, you know, obviously the market, oh, there's inflation down there, relatively small. But if we go back to the beginning of last year, I think it's important to understand where the world was coming into 2022. You know, for the better part of a decade, and certainly in response to COVID, you know, we had a very, very low interest rates. We had what we called quantitative easing from the U.S. Federal Reserve, for lack of a better word, where they were printing money and injecting lots of capital into financial markets. And so coming into 2022, that was really the stage, right? We had quantitative easing. In 2021, we also started to see inflationary pressure really begin to build throughout the economy. But the Fed, for the most part, ignored that. They said they weren't going to start raising rates until early 2022, and they stuck to their word on that one. So coming into 2022, we had very low interest rates. We had inflationary pressure building in the economy. The economy was firing on all cylinders. And then we had this brutal, ugly invasion of Ukraine. That naturally added quite dramatically, I would argue, to those inflationary pressures. We saw all-time high gasoline prices. We saw oil spike quite violently in the immediate aftermath of that invasion. And then in March, the Fed began raising interest rates. And initially they started with just a quarter point. But by May, by June, the Fed had really begun to jack up interest rates quite violently, I would argue. And that was really a major theme throughout 2022 in response to these inflationary pressures that were building. And to be fair, these are some of the most extreme inflation numbers that we had seen in 40 years, the highest inflation in 40 years. And so the Fed, I think, you know, rightfully so, was trying to play catch up. And so we saw interest rates rise quite dramatically throughout 2022. That naturally pushed down bond prices, certainly hurt the equity market. But much to, I think, everybody's surprise, the U.S. economy continued to really motor ahead. You know, we had some soft data early in the year, but by the end of the year, the economy was still continuing to expand. The labor market was still pretty tight, despite the fact that the Fed had raised interest rates quite a bit by the end of December.
So in that context, that's really helpful. Thank you. Talk to us about, now we're here in a fresh year. We're looking forward to 2023. How is all of that going to change or evolve going into this new year? And what are sort of the shifts in what those themes are going to be looking forward to 2023?
Yeah, and when we pivot and we look forward, I think we're going to see certainly a continuation of many of the themes that dominated throughout 2022. I think we're going to see interest rates continue to be a big issue. The Fed has telegraphed that they're still looking to raise interest rates, and they're going to keep interest rates higher for longer. But I think we're going to see some new topics start to dominate the headlines. And one of those is this thing that we call the debt ceiling, right? We're starting to hear more about it now in the news, in the newspapers, online, when you're reading the news. So I think the debt ceiling is going to take center stage here for a while. Certainly inflation is still going to take center stage, interest rates. So I think those are going to be the predominant themes. In equity markets, I think we're going to see some bad earnings numbers. We didn't see that last night. Morningstar reported, and they had good numbers. But I think on the whole, we're going to see earnings growth soften. So from an investment perspective, I think we're going to still see, at least for the first half of the year, pretty much a bumpy equity market. Okay.
So you touched on a lot of different themes there, a few things that I want to ask you to go into a little bit more detail on. Let's start with inflation. This is something that we got a lot of questions about. I, as someone who sit with clients every day, get this asked a lot, kind of what's going on with inflation. And I'll pose the question to you, what do you see as outlook for what inflation is going to look like over the next 12 months, or even further, what's kind of a longer term outlook on inflation?
Sure. And inflation, like I said, will continue to dominate markets, certainly throughout the remainder of this year. I think it's important to back up and first take stock of where we are today and perhaps where we were throughout 2022. And this is inflation by month going back to December of 21. And you'll see that inflation peaked in June. And since then, inflation has slowly been coming down. It has not been a straight line down. There's been a few bumps. But the last 2 years especially, we have seen a significant softening in inflation data across all the different categories that the Bureau of Labor Statistics tracks. And so it looks like at the moment that the Fed's rate increases are beginning to have an impact on the economy, are beginning to bring down prices across most sectors, most categories. Part of this is driven by the fact that we are having an unusually warm winter in Europe and parts of the United States. So the demand, the price for energy, natural gas, things like that, heating oil, has been softer than originally anticipated. So it looks like that the Fed is winning, the progressive winning the war against inflation. And I can see that this is why Jerome Powell, Fed chairman, wants to continue to raise rates and keep rates higher for longer. I do suspect the Fed will raise rates at least once or twice in 2023. Most economists project that by the end of 2023, that we will see inflation return to somewhere between 3.5%. That's still above where the Fed would like it to be. The Fed is targeting an average inflation rate of about 2% over time. So 3.5%, still running a little hot. But we do think that this is the year, when we look at all the data, when we look at where the economy is at, that the Fed should win the war against inflation.
And Don, you're talking there a lot about the Fed's response to inflation. And that's a question I get a lot, is kind of what is the Fed going to do here in 2023? What is their response going to be to inflation? How is that going to change over the year? And almost more importantly, what kind of impact does that have in capital markets?
Certainly. So I think when we back up and we look at where we are today with respect to interest rates, if we look at our little chart here, this steep slope, this here represents the rate hikes that we saw throughout 2022, and you can see that is a very significant. It's like a rocket going straight up. So to characterize last year's interest rate hikes as pretty significant, but also pretty violent, I would argue is not too much. But you'll also see here that there's two different color sort of dotted lines. And the red slope, the red line there, that is what the Fed themselves is projecting. The Fed itself is projecting where interest rates are going to go. So the Fed is still forecasting that this year they're going to take rates up to slightly over 5%. Whether or not that happens or not, we don't know. These are forecasts. And so full disclosure to our listeners, you should always keep these forecasts in context and take them with, more than a grain of salt, right? Most of these forecasts will probably not pan out, but at the moment, this is the Fed's best thinking. And I think longer term, to your question, Jess, even the Fed themselves is forecasting that they will begin cutting rates again at some point in the future. And that's where the debate is. When would the Fed begin to, one, pause their current rate hikes, but when would they begin to cut? At the moment, the Fed believes they're not going to start cutting until 2024 or even 2025.
But as you mentioned earlier, the Fed doesn't always do exactly what they say.
That is true, right? Which is one of the things they're trying to improve upon, right? They really want to have credibility with financial markets. And so I think they're trying really hard to do what they said they're going to do. Now, the challenge with that is as new data comes in, right? The Fed often claims they are data dependent and they are going to respond to new information as it comes in. Naturally, information comes in that perhaps they did not anticipate, and they have to pivot and adjust their forecasts. But this other line on our chart here is this green line. These are market expectations. So back to the data question. The market often has the same data, sometimes better data than the Fed has. And so the market is actually forecasting that the Fed is going to begin cutting rates sooner than the Fed themselves thinks they're going to cut rates. So that remains to be seen. Here's what we do know. Longer term, we think rates are going to be lower. There's lots of evidence that leads us to that conclusion. We can't say when for sure. That's the debate. That's the tug of war in financial markets. But by 2025, 2026, we do expect rates will be lower.
Okay. So earlier, that kind of brings us to a topic you brought up earlier in our word cloud, which was that R word, recession. And this is a question that I get from clients all the time. It's something that's really dominant in the headlines and something I think our clients are really worried about in some cases. So I'm curious if you can talk to us a little bit about the possibility of a recession in 2023, and maybe even more importantly, what people can do now to prepare for that possibility.
Yeah, so I think if let's look at the data again, and we actually have some data here to take a look at. When we actually look at the data, let me just fix my pen here. There we are. When we actually look at the data, what we see is that the economy is actually slowing down quite a bit. And so we see that here when we look at the Purchasing Manufacturers Index data. And so you'll see some numbers over here in the upper 40s. Anything less than 50 suggests that the economy is already in contraction across these different major sectors, the manufacturing sector, services sector, and different markets. And you'll see that we went from green when the economy, was running pretty hot, firing on all cylinders. And now things are looking yellow and even perhaps a little orangey, right? That tells us that economic momentum, economic activity is slowing down quite significantly, which makes a lot of sense. The Fed has significantly increased interest rates, and it logically follows, hey, the economy is going to respond to that. And we are starting to see, home sales are going down and things like that because, mortgage interest rates are a lot higher, and all of these things are starting to have an impact on the economy. So perfectly logical. Whether we tip into recession in 2023, again, remains to be seen. Again, same disclaimer with respect to forecasts. We want to be very careful putting too much stock in these forecasts. But the data suggests that a recession is in the cards. I think something like 80% of economists at the moment are forecasting recession. And I would be careful, just because 80% are forecasting that we're going to tip into recession does not mean it's going to happen. All right. Now, to your question around what can clients do to prepare for a recession. And I would say first and foremost is making sure that you have a plan in place. The reality is, look, recessions happen with a fairly high degree of frequency, right? So having a great plan in place, making sure that you have sufficient liquidity, right? Making sure you have a cash reserve, that your family can rely on to help you through any economic challenges that you might face. That's just good financial planning. I don't know that you would do anything any different in response to the prospect of a recession. Certainly you can't time financial markets based on the prospect of a recession, and that's because financial markets are always ahead of what's happening in the economy. So if somebody tells you there's going to be a recession in June, chances are that's already priced in the financial markets. So trying to trade on that information, I would argue, would be very dangerous. So from a planning perspective, have a plan, right? Work with your trusted advisor. Make sure that you understand the information that we're reading in the news. A lot of this economic information can be a little dense. I just highlighted this purchasing manufacturing index. What is this, right? Talk to your advisor. Your advisor can help you understand this data and then help you figure out how to put it in context and then determine, okay, is this really actionable information? Should we do anything different now based on this information? Chances are, if you already are working with a trusted advisor and doing some great financial planning, chances are your advisor already has prepared you for the prospect of a recession.
Right. And I love, as an advisor myself, I love that you answer that question with a planning answer, because really, if you take this chart back further, you would see, to your point, that every 5 years or so, on average, we go through a recession. So for my clients that are 60, 65 and retiring, the likelihood that they're going to go through a recession 6 or 7 times during their retirement journey is pretty high. So there's so much energy spent on trying to figure out exactly when that's going to happen, try to figure out if and when the storm is coming and how to adjust your portfolio in response to that, when in reality, a lot of what helps get through that is positioning your portfolio properly at the onset before it ever happens, and then doing some of that planning work to make sure you're not retiring prematurely, you have a sustainable distribution plan from the portfolio, and the portfolio is allocated in such a way that you can really ride through that storm instead of trying to figure out in time exactly when it's going to happen.
Absolutely. Couldn't agree more.
Okay. Then let's move on and talk about a topic that hasn't come up quite yet, which is debt ceiling. So talk to us about how the market would react if the U.S. were to get close to defaulting on its debt, and sort of how that moves markets.
Well, first off, I would say even the mere prospect of a U.S. debt default is extremely alarming, right? The value of, let me say it this way, the credit rating of the United States really underpins the entire global economy in so many ways. So that would be extremely alarming. Now, with respect to the question, how might financial markets respond to a default or perhaps a near default, right? Where there's this prospect of, having an impasse in Congress for a period of time, and that's going to create some anxiety in financial markets. We can actually look to market history. We actually have some examples that might provide some insight for how to think about that. And, 2 immediately come to mind. There's certainly a few others. I just wrote a paper on this that'll be posted to our website shortly. But the first would be in 2011. We had a debt downgrade. Standard & Poor's in April of 2011 put the U.S. credit rating on a negative outlook. Right? They didn't downgrade it yet, right? But they put it on a negative outlook. And that was because of this political impasse in Congress around the same exact issue, whether or not to increase the debt ceiling. Well, by the end of July, Congress did vote to finally increase the debt ceiling, but the damage was already done. On, I think it was August 2nd or 4th of that year, Standard & Poor's downgraded U.S. debt from AAA to AA+. And the market violently sold off. I think it was about 14%. The market sold off in a very short period of time. So that gives you some insight that even though we did not default, it certainly spooked financial markets and certainly spooked the major credit rating agencies enough to downgrade our debt. Now, a more recent example, just from late 2022, is we can look to the United Kingdom. right? They elected a new, the Conservative Party elected Prime Minister Liz Truss. She proposed a series of economic policies, and whether or not they had merit or not, we should put aside, but it was a series of policies that financial markets collectively had judged to be fiscally irresponsible. And what happened is when she presented those policies and through this mini budget that the UK was going to put in place, what we saw is interest rates on 30-year UK bonds actually doubled.
Wow. Right,
from 2.5% to 5%. We saw the British pounds sell off about 7 or 8% relative to the US dollar. And then we also saw UK stocks, British stocks, sell off about 14%. And in fact, it was such a violent reaction that the entire British pension system almost went into bankruptcy. Right? Now, the reaction was swift, and Prime Minister Truss was forced to resign, shortest prime ministership in British history. But I would argue the damage was already done. And this is really the point of this particular example, is that even though the new prime minister came in and they basically walked back all of those policy proposals, today interest rates on those same bonds are still around 4%. And what that means is all the consumers in the British economy that borrow now have to pay higher borrowing costs. The British government has to pay higher interest now on its debt outstanding. So those policies, even though they never became law, continue to extract a very heavy burden on the British people. And so those are just two examples. I'm not saying that would happen in the event of a U.S. default or near default. I'm just saying that those are two historical examples that could provide some insight with respect to what potentially could happen here.
Sure. So we've talked a lot about these high-level concepts relative to the economy. We talked debt ceiling, inflation, Fed, interest rates, and really the fact that capital markets have shifted and the economy has shifted quite a bit since where we were a year ago. So thinking about this new environment that we're in today, I want to get a little bit more tactical and kind of bring it back to the individual investor. How would you think about allocating portfolios? And I want to start with fixed income. So we got a lot of questions specific to bonds, CDs, the yield curve. So talk to us a little bit about the yield curve and how to think about investing fixed income portfolios these days.
Yeah, no, it's certainly a great question. And so I think the best place to begin is let's take a look at the yield curve for U.S. Treasuries. And I think what we should do here is just stop for a second and define what is a yield curve, right? Because this is really material for informing how we think about fixed income in a portfolio. And so a yield curve just shows you the yields, the interest rates for bonds of different maturities. Okay? And so this pink line, this raspberry line here at the top, what you'll see, for example, is short-term treasuries, 6-month treasuries specifically, or 3-month treasuries, are currently yielding somewhere around 4.79%. And what you'll also notice is that, okay, as I go out in time, if I were to lend out my money, remember a bond is just a loan. You're lending your money to somebody. In this case, you're lending your money to the U.S. Treasury to finance that debt that we have, right? Interestingly, if you were to lend your money to the federal government for 10 years, you're only going to earn 3.37% today. Whereas if you lend it to them for only 6 months or 3 months, you're going to earn 4.79%. This is what we call an inverted yield curve, where future longer dated bonds have lower yields than shorter dated bonds. This is not normal, right? This is an inverted curve. It does happen quite often throughout economic history, and it's actually a classic sign that perhaps a recession is coming. Right? It's a powerful predictor of a recession. It is not a perfect predictor of a recession. So again, full disclosure, right? But this also tells us as an investment team, how should we be thinking about allocating bonds within a portfolio? Well, it tells us that we want to be right where that yield curve is kinked, right? So shorter term bonds right now are paying you more. Right? What it also tells us is we're not being compensated for taking on more risk. Risk being here defined as lending out your money for long periods of time, right? That is what we call duration risk. right? So we're not compensated for that. So the way we think about portfolios is we always want to be where that yield curve is kinked for each bond asset class, whether it be corporate bonds, municipal bonds, treasury bonds. That's how we think about allocating within bond portfolios. So right now we like shorter term bonds over longer term bonds.
And this yield curve might look slightly different when you're not looking at just the US Treasury, if you're looking at municipal bonds, corporate bonds, but that idea of, in all cases, shorter term is paying a little bit more than longer term bonds.
That is correct. Or it could be flat. And even if it's flat, you would say, well, gee, why would I take on that extra risk and lend out my money for 10 years when I can earn the same interest rate lending it out for, say, 1 year or 2 years?
Right. And really fascinating here how dramatic of a change that is from just 1 year ago. I see that line there at the bottom is from end of the year 2021, and how we went from really low rates to much higher rates, and from a normalized yield curve to an inverted yield curve. So really big dramatic changes there in the fixed income environment. Also the case that, as you were talking earlier about the equity market, there's been dramatic changes there relative to valuations and where the market is today versus where it was a year ago. So talk to us a little bit about how you'd be thinking about allocating your equity side of the portfolio, and given today's market environment, how you're thinking about growth versus value, or just thinking about stock investing in general.
Certainly. So, I think high level, the first thing to acknowledge, again, if we go back in time and we look at where valuations were for equities, and let me define that in a moment here, but valuations for equities were high, relatively high, at the end of 2021. So what are valuations? Valuations is just a way of us, for professionals to think about what's the right price for a company, right? What is the price of a company? So in this particular chart, we're looking at something called the price to earnings ratio. So that's the price of the stock relative to the company's earnings. And we'll just call those profits, for lack of a better word right now, right? And so price is what you pay when you buy a share of a company. The earnings are what you get back in return, right? So that's why it's very important that we pay attention to valuation, right? It's our way of making sure that we are not overpaying for earnings. And at the end of the day, whether those earnings come from a technology company, whether they come from an energy company or some other company, it doesn't matter. A dollar is a dollar is a dollar, regardless of what type of company generates that dollar. So what's material is, well, what do we have to pay in order to have a claim on that dollar, right? In the form of either dividends or something else called retained earnings. But if we go back to the end of last year, we'll see that valuations were pretty high. In fact, they were almost approaching their highs from the dot-com bubble. For those of us who were investors back then, that was a painful time when we saw that bubble burst, right? So valuations were high coming into 2022. 2022, due to all those rate hikes that we were discussing earlier, we saw equity prices come down. So valuations came down. So coming into this year, right now, the market is priced pretty much close to its long-term average. So said differently, the equity market today is actually healthier than it was this time last year for investors. That's a good thing. All right. So the market today is trading around 17 times earnings. Again, that's pretty much on par with its long-term average. Now, when we look inside the market, it's important to keep in mind that not all stocks are trading at 17 times earnings. There's obviously a dispersion around that average. Companies that trade at higher valuations are typically referred to as growth stocks. So they have pretty high prices relative to earnings. And the thinking is that they're going to grow those earnings over time to justify today's high valuation. That's a growth stock. Value stocks have valuations below the valuation of the broad market. So those are value stocks. Think of companies that, for whatever reason could be unloved, they're just not popular, they're not the shiny new object. Think of a company like McDonald's or Johnson & Johnson. These are classic companies that print lots of money, but they're just not very glitzy, like perhaps an Apple or something like that. So Apple's probably not the best example, but it is an example. we like value stocks. If you look at our portfolios, the way we think about the world, we want to tilt portfolios towards value stocks. Value stocks over long periods of time, not every year, not every time, but over time, have been shown to outperform higher priced growth stocks. So for long-term strategic investors looking to build wealth for retirement, looking to build wealth to send a child to college, having those value stocks in the portfolio, we believe makes a lot of sense.
Okay. So you talked there a little bit about value stocks and certain types of companies that are traditionally value stocks. You brought up McDonald's, companies like that. On the growth side, we had a question come in relative to the technology sector. So I know that how Mercer invests is not necessarily rotating in and out of certain sectors, but I'd love your thoughts on, with all of the headlines these days about layoffs just this last month at Microsoft, Google, Salesforce, how that tightening in the tech sector may reverberate to the rest of the economy or affect markets as a whole.
Yeah, and I think it's I'll go back to what I said a few moments ago, because I think there's a point there that bears repeating. Whether a company, whether a dollar of profits is generated by a technology company or an energy company or a healthcare company, I would argue is completely irrelevant, right? An American dollar is a US dollar. Right. So I would encourage us to keep that in mind. So the way we think about asset allocation and diversification, you're right. We do not look at that through a sector lens. We look at that through a valuation lens. We look at that through a profitability lens, looking at fundamentals. Right. So but with respect to the question and with respect to technology, if we look, for example, at the Russell 1000 Growth Index, right, that is an index that tracks the growthiest companies in the US large cap and mid cap markets. 43% of that index is technology.
Wow. So
really, really overweight tech. Now, that's not to say that there aren't great values within the technology sector. Indeed, there are. There are companies that trade at lower prices relative to their earnings, right? So it's not an indictment of all technology companies. And that goes back to why I think having that valuation lens is critically important and not getting so hung up on the sector. Now, when we look at technology this year, it's projected to grow earnings as a sector by about 4% this year. That's pretty much on par with the broad market. So we're not seeing them really, we're not seeing a bunch of fireworks from technology, at least in terms of earnings growth this year. It's consumer discretionary, financials. Those are the sectors that are projected to have the best earnings growth this year. So at least when I look at technology as a sector, and again, I wouldn't get excited about a company just because it's a tech company.
Right.
I would look at fundamentals.
Okay.
Right. I think fundamentals really matter.
Okay. And I'm sure that that level of discipline really helped us throughout last year, that rather than having an over tilt to certain parts of the market that had done really well leading into last year and then didn't do as well last year, was nice to have some discipline in those portfolios to cushion the downside a little bit so that there wasn't just this overweight to something that fell 40, 50% in some cases.
Absolutely. And when we look at equity returns last year, value stocks significantly outperformed their growth stock counterparts. In fact, when you look at like the FANG stocks, last time I looked, the FANG stocks, so FANG stocks, for those who are unaware of that nomenclature, that's Facebook, which is now Meta, Amazon, Apple, Netflix, Google, which is now Alphabet. So it worked really well before those companies tried to change their names and rebrand, but that's what I mean when I refer to FANG stocks. So those are like the largest techie companies in the market. I think they lost about 45% last year, right, as a basket, whereas value stocks lost somewhere around 7% if you look at like the Russell 1000 Value Index. So pretty big dispersion there in returns. And to your point, technology stocks did really well until last year. And in fact, last year's losses in technology were so severe that when we actually look at the returns on growth stocks as a whole, they now have underperformed value stocks over the past 3 years.
Wow.
Right. Wow. So it was a significant hit that we saw last year to growth stocks, which really forced them to give up a lot of the great stellar returns that they had, through COVID and here at the end of COVID.
So having a more diversified portfolio really dampened that volatility, sounds like.
It's amazing. They say diversification is the only free lunch in the market. And last year we got that free lunch. To be fair, on a relative basis, value stocks did well, diversification did well, but on an absolute basis, I mean, let's just call it what it is. As investors, we don't like losing money, right? So while a diversified portfolio certainly lost less than, say, the Russell 1000 Growth Index, which was down, I think, somewhere in the high 20s last year, almost 30%, it was still better than losing 25, 30, or heaven forbid, 45%. So, diversification works even when we don't want it to, when times are good, but it certainly works when times are pretty bad.
Okay. So we've talked mainly today about the U.S. economy and U.S. markets. We talked about Fed, inflation, things that, it's very central to the U.S. and the U.S. economy. Let's shift gears and talk about overseas markets and how you would think about non-U.S. portfolios and kind of make a case for me for why you should not only be invested in the U.S.
It's interesting. I get this question a lot. I've been getting this question a lot for the better part of 10 years. And, if we look at non-U.S. equity returns for the past 10 years, they've quite significantly underperformed their U.S. counterparts. And so, we always get these questions, well, gee, if the U.S. is outperforming, why not own more U.S.? And so, but if we back up and we take a broader view of history, the first decade of this century actually saw the opposite. Right? U.S. equities were pretty much flat for the first decade of this century. And it was the non-U.S. equities that provided outperformance, right? So shockingly, I say that a bit facetiously, we saw that non-U.S. stocks delivered when U.S. stocks weren't doing very well. And then we saw the opposite. That's why we diversify, right? So number one would be just market history. It is very rare that a single asset class continues to outperform all the time in perpetuity. We just don't see that. So we'll probably see some reversion to the mean, where you're going to see some years where non-U.S. equities are going to outperform their U.S. counterparts, right? That helps cushion portfolios. So number one would be market history. Number two would be just revisiting that valuation lens that we were talking about a few moments ago. If we look at non-U.S. equities and we look at their price to earnings ratios, they're trading at about 13 times earnings. I just showed you a slide right here where the U.S. is trading at 17 times earnings. And remember, a dollar is a dollar regardless of where it comes from, right? So non-U.S. companies are trading at a pretty significant discount relative to their U.S. counterparts, arguably 30% discount. So from a valuation perspective, non-U.S. equities are attractive just on that basis alone. And then the final point that I think is important is that the US dollar today is extremely strong relative to non-US currencies. So why is that even important? Well, the strength of currencies relative to one another actually has a significant impact on the returns that we as US-based investors actually realize. So when the dollar goes up, that's actually going to hurt our returns on non-US assets. And the reverse is also true. So if the dollar were to begin to weaken, I don't know, maybe because we have a recession, right? If that dollar begins to weaken, that's actually going to help our portfolios have better returns on non-US holdings. So it's a form of diversification in our portfolios. So I would say now's a great time to go to Italy. If you've been putting off that trip to go to Italy or something like that, now's a great time to do that. The dollar is really strong.
Talk to your financial advisor first.
But the likelihood of the dollar staying as strong as it is today, probably not. Probably going to soften at some point. Non-US holdings can help diversify against that.
Okay. So it seems like every question I've asked you, whether it's around fixed income and staying disciplined on that shorter portion of the yield curve, or around growth versus value and staying disciplined in less expensive companies, or whether it's in US and international and making sure that you don't give up on international allocation, your responses have consistently been some version of stay disciplined, stay diversified, stay the course. So how would you respond to the feedback that, well, Mercer's just a buy and hold shop, we don't actually make any changes? Do you have any kind of tactical asset allocation moving between different asset classes or different sectors? Why aren't we doing that?
Yeah, it's a great question. So the way to think about our portfolios is think about them in terms of three levels. right? So there is lots of activity in your portfolio. You just need to know where to look, right? So the first most basic level would be at the account level for clients. We rebalance portfolios, right? So as portfolios become lopsided, let's just say stocks outperform bonds, we rebalance portfolios. We're going to sell some of the stocks and buy the bonds. That is activity. That's, that is, I would say that's actually pretty tactical, right?
Right.
So that's the first level. That's what I call level 1 activity at the account level. Level 2 activity is when you look inside the holdings in your portfolio. Let's just look at one of our value managers, for example, Dimensional Fund Advisors. So if you look inside their fund or their ETF that they're running for us, they're actually constantly rebalancing that portfolio with new cash flows. In fact, every day they go through this exercise where cash comes in or they're reconstituting the ETF. So there is constantly rebalancing occurring within, for example, the ETF. It is so much more tax efficient, just by law, to do that rebalancing within the ETF. And so if you look at an ETF or a fund manager, oftentimes you'll see turnover rates of 15, 20, 30%. Some of our momentum ETFs have turnover of 50 to 80%. Now, you don't see that optically, but it's important for all of us as investors to know, hey, that's there. And it's more tax efficient for that trading activity to occur there because we're not going to get big, ugly 1099s at the end of the year.
Right.
Now,
so you open up your Schwab, Fidelity, TD Ameritrade statement. It may look like nothing happened or Mercer did a small rebalance, but underneath the hood, there's a lot going on there.
Absolutely. So you just got to know what to look for and where to look and make sure you understand what you're looking at. So that would be the second level of activity. The third level of activity is what the decisions we make as an investment committee, which I think is what is behind the question. Is I don't see Mercer doing a bunch of shifting. Well, indeed, we do from time to time, but only for the right reasons. We're not going to shift a portfolio and incur a bunch of capital gains just to dress it up. In fact, many managers do that. We call it window dressing. If we're going to make a shift in a portfolio, we want to make sure that it's going to add some value. And I'll just give you an example from last year. Our investment committee in many of our portfolios shortened up duration. So back to our discussion from earlier, the yield curve was shifting last year, right? At the end of December, the yield curve was this gray bar that we see here, but the yield curve was changing. The Fed told us they were going to start raising rates, and quite significantly. In January, we shortened up our bond duration in our portfolios, in most of our portfolios, by shifting out certain ETFs and funds and going with shorter duration, shorter term, because we wanted to be here. Remember what I said earlier, we want to be where that yield curve is kinked. We did that in January, we did it again in late April, and I'm glad we did in hindsight. We were just, we weren't forecasting, we weren't predicting where the market was going to go, but we were responding to this information that the market was giving us, right? So we were just responding to the yield curve. It made sense. It was a prudent move. So yes, we are tactical. So that is level 3. But if we are going to make those changes, we're going to make them for the right reasons. We're not going to make them, just so it looks good. We want to make sure that there's a good, rational, quantitative rationale behind what we're doing.
Okay. So Don, where I want to take us here towards the end is we talked about a lot of different topics today, most of which, quite honestly, are not totally in our control. We can't control what the Fed's going to do. We can't control what's going to go on with interest rates. We can't control whether or not the U.S. is going to default on our debt. So I would love your perspective on just looking forward to the year ahead. If you could give investors and clients out there one piece of advice, one action item, one thing to really focus on for 2023, what are 1 or 2 things that you'd ask people to focus on?
There's certainly a laundry list, Jess. And I think it's important to understand that we have busy lives. Most of our clients are not professional economists or professional, financial experts. And especially coming out of a year like last year, there's going to be lots of sales pitches that come out of the woodworks from product sales folks trying to show you, what, quote, worked last year.
Right.
And I would be very cautious of those sales pitches. We're also in a market environment where, inflation, debt ceiling, interest rates, there's a lot of complicated economic information that's being thrown at us as citizens and as consumers and as investors. And I think if there's just one thing I would encourage our listeners to do is work with a trusted advisor. Your advisor is an expert in these things. Your advisor can help you interpret, what is this information? Like I said, most of our clients are not professional economists. So understanding what is the purchaser's manufacturer's index, right? The PMI. Understanding, well, how should I think about inflation? How does it affect me personally? Inflation is a basket of some hypothetical U.S. Households' purchases throughout the year, and that hypothetical household does not even exist. So working with a trusted advisor to interpret this information, understand this information, and then most importantly, assess, is it actionable? Should you be doing something differently in your plan, in your portfolio, in your life, given that information? Our job as advisors, I say this often, is to help our clients make the best informed decisions possible, affecting the financial lives of them and their families. And so before you make a decision based on a sales pitch or some information that you're seeing in the news, talk to somebody that you trust, somebody who is knowledgeable on these things. They can help educate you, help you set some context for that, and then help you assess whether or not it's actually actionable information. Yep.
And as someone who sits across from clients every day, I would just echo all of those comments. I know that advice might seem a bit easy or self-serving, but I can tell you that having sat in front of hundreds of clients, we talked about all these concepts today relative to the economy and the markets, again, which are in most cases out of our control. So how do we think about the things that we can control? And even if everything we talked about today goes perfectly well and inflation settles down and we get a nice soft landing and there's no recession and everything goes perfectly, but you haven't done the planning with your advisor going into that to prepare you for retirement, to prepare you for a sustainable distribution plan, if you're not crystal clear on exactly what you're going to need to pull from the portfolio and what the taxes on that look like, even the perfect environment in the markets can't fix poor planning. So I would really encourage you to take an opportunity following our call today to reach out to your advisor if you don't already have your next meeting scheduled and get that on the books, to really look at every single asset on your balance sheet and figure out, okay, based on what Don just talked about today, are all of those assets really optimized for your economic freedom? Is every Mercer account, every outside account, every piece of real estate, insurance, et cetera, really optimized for your goals and objectives?
And just to echo that, I think of that as connecting all the dots, right? Our balance sheets are complex, our lives are complex. There's a lot of moving parts, right? Just think of my family with children in college and a daughter getting ready to go to college, and supporting elderly parents. Working with somebody to help me connect those dots and run some interference between stimulus and response to slow me down. At least I find that to be really valuable. And I work in finance, so having somebody slow me down and say, well, did you think about, how are you going to pay for your daughter's college? How are you going to pay for your parents' long-term care and things like that? So connecting all those dots, I find that gives me clarity. That gives me the information I need to make the best, most well-informed decision possible for the people that I love the most. And so I find a lot of value in that.
Great. Well, with that, I think I will say thank you, everyone, for joining us today. Thank you, Don, for being here with us and sharing some of this important information. A replay of today's conversation is going to be posted on our website at merceradvisors.com under that Insight section. I do need to remind you all today that today's discussion was meant to be general educational material, so you should not consider any information provided today as personal financial advice. Again, if you have questions about how anything we talked about today here applies to you and your personal situation, you should reach out to your local wealth management team. Your advisor would be happy to review your specific plan with you, make sure you're on track, take a look at the portfolio, and talk about whether you are really positioned well for the current environment. I know I speak for the entire advisory team here at Mercer Advisors when I say that we really consider it a privilege and an honor to serve you and steward your hard-earned wealth. We do not take that responsibility lightly. So thank you for being clients. Thank you for the opportunity to serve you. And thank you, Don, for being with us here today.
Great. Thank you, Jess. It was great to be here. And thank you, everybody, for your time today.